Michael Burry's shocking warning: the bubble is about to burst very soon. Prepare for the worst. The U.S. housing market has been silently watching the uncontrolled growth of a nationwide home price bubble over the past few months. However, third quarter numbers suggest that the market may have been stretched to the limit as home sales significantly collapsed for the first time in almost 18 months due to sky-high prices and the prospects of higher interest rates. Today we're going to talk all about Michael Burry's warning about the upcoming housing crash. So watch the video till the end, because today's video is going to be bomb. Welcome to Michael Burry Secrets, your daily dose of Michael Burry. If you're interested in everything around Burry, this is the place for you. Subscribe if you want to stay updated with all the Michael Burry secrets, predictions, and stay one step ahead in the financial world. Watch the video till the end, and make sure to hit the like button if you want to be a millionaire within the next 3 years. Don't forget to enable all notifications to join our weekly cash giveaway pinned in the comments. Now let's get to our topic. The U.S. housing market has been silently watching the uncontrolled growth of a nationwide home price bubble over the past few months. However, third quarter numbers suggest that the market may have been stretched to the limit as home sales significantly collapsed for the first time in almost 18 months due to sky-high prices and the prospects of higher interest rates. Worsening affordability means that fewer Americans can actually make the dream of owning a home come true, and as a result, the market slows down and prices start to come down to earth again. The latest reports indicate that we're at the end of a euphoric market, and a downtrend is right around the corner. Skyrocketing home prices will have to readjust and meet our economic reality. In other words, even though people are too conservative to bluntly say it these days, the U.S. housing market is set for a crash. That's what Ivy Zelman, a housing analyst who became famous on Wall Street for calling the top of the 2008 bubble, has warned in a recent interview. Zelman revealed that she's seeing several red flags once again. In less than 2 years, the U.S. housing market has seen a historic run-up in property values, unlike anything we've ever seen before. But we're now at the peak of the bubble. She's alerting her clients that overheated areas with heavy concentrations of investors are likely to face corrections, the industry's term of choice not to spark panic on the public. But in essence, we all know that corrections stands for sharp crashes in overinflated property values. Zelman says that even a small rise of 1%, setting rates at 4%, would bring demand to a halt. In a recent interview with Bloomberg, she said that cracks are already appearing everywhere. The analyst says that today's fundamentals are different from the last bubble, which was supported by risky subprime mortgage lending. But the signs of trouble look familiar, she says. Investors are distorting the market by driving up prices beyond the reach of primary buyers, and builders with growing construction pipelines are bidding up land values. Given that the Federal Reserve has signaled that it will start to roll back its bond purchasing program and raise rates in the coming weeks, Zelman says that some of her predictions may not come to fruition this year, but probably early on in 2022. But we definitely see a storm brewing, she continues. The analyst argues that excess liquidity in the markets led investors to fuel a speculative bubble in the housing sector, with iBuyers, private equity firms, and sovereign wealth funds propping up property values in an attempt to collect higher returns. When asked if she sees a housing market crash coming, the analyst warned that property values have to go down. There are going to be corrections, and I think there are going to be corrections that are even more pronounced if rates go higher than 1%, she cautioned. Just like Zelman, many others in the market are also suggesting that the third quarter of 2021 likely marked the peak for the housing market's price bubble, and from now on, real estate prices are bound to collapse. In many cases, the drop will likely be a painful one. According to economists at Fannie Mae, housing inflation is expected to drop by at least 2% this quarter, as the bubble loses some steam. The industry consensus right now is that there's no way to support the continuing rise in home prices. Already, due to increasing affordability challenges and the estimates of higher mortgage rates, home sales fell 5.8% from a year ago. Fresh data from the National Association of Realtors point that actual sales of all types of existing homes fell 8.2% year over year to 526,000 homes, and sales of condos and co-ops dropped by 8.1% year over year to 57,000 units. Considering today's sky-high prices, the housing market is much more susceptible to higher mortgage rates than in prior years, which means that property prices will have to sharply readjust to reduce the affordability gap. Some industry cheerleaders say that today's overinflated prices are a matter of simple supply and demand, but the truth is that demand means having buyers who can actually afford to buy. Unfortunately, those who entered the bubble thinking they would have massive returns are set to be disappointed. Millions of Americans are about to see the value of their homes dramatically crashing. Just as every bubble artificially inflated by the Federal Reserve over the past year, the housing bubble is headed to burst, and that meltdown will begin as soon as interest rates start going up. Fabled stock picker Peter Lynch recently criticized the shift towards passive investing, warning buyers of index funds and exchange-traded funds that they're losing out on superior returns. Michael Burry, the investor of The Big Short fame, has also complained about the trend and cautioned it could be disastrous. This move to passive is a mistake, Lynch, who delivered an annualized return of 29% over 13 years as the manager of Fidelity's Magellan Fund, said in a Bloomberg radio interview that aired this week. People are missing the boat, he added, noting that he expects the best active managers to consistently trounce the market. Meanwhile, Burry called the passive investing boom a bubble in a Bloomberg interview in 2019. The Scion asset management boss observed that the trend was sapping interest in smaller, undervalued securities around the world. There's all this opportunity, but so few active managers looking to take advantage, he said. Burry also suggested the dearth of active managers was stifling shareholder activism. Passive managers tend to be less confrontational with company executives, whereas Burry wrote several letters to GameStop's directors in 2019. He called for a board overhaul and criticized its executives' compensation, acquisitions, and lack of share repurchases. The Scion chief revisited the subject of passive investing in a September tweet. He warned the flood of millennial money into index funds and ETFs was fueling unsustainable valuations and putting the stock market in a precarious position. Parabolas don't resolve sideways, he said. Burry shot to fame for calling the mid-2000s housing bubble and making a fortune by betting on a crash. The contrarian investor also took short positions against Elon Musk's Tesla and Cathie Wood's ARK Innovation ETF earlier this year. Moreover, he invested in GameStop back in 2019, laying the groundwork for the short squeeze on the stock at the start of this year. It's hard to say whether Lynch and Burry are right about the downsides and risks of passive investing, but there's a clear shift from active to passive. The value of passively managing U.S. assets has ballooned from $3.1 trillion at the end of 2016 to $7.5 trillion today, whereas the value of actively managed U.S. assets has only grown from $3.7 trillion to $6.1 trillion over the same period, Bloomberg data shows. Well, that's it for today's video, guys. Also, we would like to mention that this is not a channel intended specifically to provide financial advice, and we do not ask you to invest in any company. This is merely a channel directed towards bringing educational content to your doorsteps. With that in mind, before you invest in anything, we recommend you do thorough, wide-spectrum research on the topic. And make sure to subscribe and give us a thumbs up. See you next time on Michael Burry Secrets. Bye.